everyone. I would like to welcome you to the private markets panel. I have with me on my very left Daniel Maier from Chartered Investment and Tasso Politis from Ancala right next to me. And we will talk about private markets. Looking forward to an interesting discussion. My name is Andreas Rothacher. I am the head of investment research at Complementa. And maybe let's start our discussion. Could you please quickly introduce yourself and give us a brief overview where your touch points with private markets are and which fields you're active?
Hi everyone, my name is Tasso. I'm part of the Ancala Partners team in London. We are a mid-market infrastructure investment manager. So we have 4.5 billion euro of assets under management, largely on behalf of pension funds, insurances from all over the world. And then our task is to invest that in profitable, stable infrastructure businesses across Europe and now starting in the US as well. And that's a whole range from airports, renewable power generation, utilities, even in the area of social infrastructure. So very happy to speak on this panel today. Thank you.
Thank you, Daniel.
Great to be here with you, Andreas. Tasso, so looking very much forward to an interesting discussion. My name is Daniel. I'm co-founder and CEO of Chartered Investment. As Chartered Investment, we provide infrastructure to the capital markets, to our partners in the capital market. This infrastructure is based on different pillars. One pillar is securitization, so to produce a financial product out of a certain pool of underlying assets. So that's one pillar. The next pillar which we are active in is the indexation. So we calculate indices for structured product issuers, for ETF issuers, and for other means where you always require a benchmark. And the third pillar we are active in is the tokenization of fund shares, of other financial instruments, can be equities or again debt instruments, by the means of utilizing the German legislation and to issue the native security tokens. We then develop, together with our partners, certain solutions, which then can be utilized in investment products. And through this, we obviously have different attachment points to private market assets. Since we are active in 2013, we securitized almost anything from venture to private equity to different forms of receivables and trading strategies and the traditional structured products, but especially the private market field I think is very interesting. So I'm very happy to discuss that further with you guys.
Thank you. Private markets and the respective investment universe have increased significantly over the past few years, and I would like you to, maybe you can highlight the implications this has to your work.
Yeah, let me eventually start off with a big picture on private market investments. And you have always different panels in that field. And one key driver in private markets is the changing geopolitical situation. So we see, and I think all of you heard that many times, that we have a need that public funding is supported by private market funding to allow the infrastructure of the future to be built. E.g. in Germany, we just released this 500 billion fund to support infrastructure and defense spending, but all this money will not be enough. So there's different legislation in different parts to support investment into private markets. And I think that's something we all need to remind ourselves if we then dive deeper into the different part of private market investments. And the different panels which you can see are either based on the political discussion or more on the actual investment and how you can invest into that. As a starting point, and then to hand over to Tasso, I would be very much interested what experience you made with private market investments. Who of you either runs an investment strategy on private market, has invested into private market? If you could just raise your hand who already did something or who's completely newbie to that topic. So the right-hand side is experience, the left-hand side is...
It's about maybe a third of the audience that is in some capacity involved, it seems. Yeah. Maybe Tasso, you continue?
Yeah, sure. From our side, infrastructure is still a relatively new asset class when it comes to private investment. And on the one side, it's great that there is more and more interest from pension funds, insurances to invest in that asset class, because it does provide security, stability in times when maybe other more like private equity style investments are maybe a bit more volatile. And that's really great. That supports us. On the other side, what that means is we as a fund really need to differentiate us a little bit compared to some of our peers who are getting more and more. And how do we do that at Ancala is we really focus on what is important for our investors, and that is absolute downside protections. So events like COVID, rising interest rates, they should be balanced out in our portfolio. They shouldn't have a material negative effect. On the other side, we need to actively manage our portfolio companies, unlike maybe some others, to make sure that we get the value from the investments that we can. So what that means is not leaving the companies completely on their own, because then they would not necessarily develop in the way that our investors want them to develop, but instead really actively working with the portfolio companies, playing an active role on the board of those companies, and really help them to drive performance. And another point is, over the past couple of years, given the more higher interest in infrastructure, the spectrum of what counts as infrastructure has really grown, and sometimes we're a little bit skeptical whether that goes in the right direction. So I think more and more asset managers say certain asset classes are infrastructure, say data centers without key customers or anchor customers, whereas we are more sticking to the rules of, well, what really gives downside protection, where you have secured income, and invest in those and stick to our game.
So if I understand correctly, you say, okay, we have a lot of new opportunities in this field. Of course, asset managers are also seeing these opportunities. They're also launching products. And so the end investor has to be really selective about what they want from this asset class, and then product by product, check whether the characteristics that I have defined in my asset allocation, they are actually met by a manager or product.
May I ask an additional question to the right-hand side of the audience, because the left-hand side never heard anything about private markets, so we just forget about you. What kind of asset class in private markets did you invest in so far? Is it venture, private equity, infrastructure, private debt? How would you label yourself? Let's start off with private equity venture. Okay, then on the let's just say on the debt side, then who was on the debt side, the remaining part, or do we have an overlap here? Tasso, would you consider debt to infrastructure, or is that a third?
No, it's definitely different to what we invest in.
Okay, so then infrastructure, according to your definition, who would invest in, or who has invested in infrastructure? So we're having a mixed audience, I would say. So we do not have a clear trend between equity, debt, and infrastructure. And you just mentioned you see infrastructure, not at debt. So what would you define as infrastructure?
Now, so we are making equity investments only into our businesses. And why do we do this? Because on the debt side, we just simply wouldn't be able to generate the returns that our investors want from us. They might well have an allocation to debt as well, but the reason they invest into funds managed by Ancala is because they want to have that superior return. Now, what we not do is to just go materially higher up the risk curve to deliver that return. Instead, what we have done, and we have done very well, is to find opportunities that maybe others are overlooking, which then means we can get those for a lower price and thereby delivering the returns. So let me give an example. We bought a rail transport asset in Sweden in August 2020, so in the midst of COVID, where no one else was touching transport because nobody knew how it's going to develop over the next couple of years. But we did a very thorough due diligence. We made sure we have that downside protection, And that allowed us to make that investment at a time when no one else was considering it, which then allowed us to get it at a good price and then deliver a good return for our investors.
It's an interesting example. I mean, sometimes I hear from the end investors, so pension funds, and also when you read like Bain Capital reports, that, for example, dry powder is very high. And if everyone is interested in an asset class, of course, at some point you raise the question, is there too much money chasing too few opportunities? I mean, in contrast to COVID, where in a lot of asset classes, I mean, the safest asset you had was cash, right?
Before I let Tasso answer to that one, I think the example you've given is a wonderful example. So it's about transportation. Who should finance transportation normally? It should be the state. But the state does not have any more money. So they need to bring in the private sector for that kind of financing. And that's great that you then filled this gap. So to add to Andreas' question, if there is enough money, might it make sense to also make a distinction between public and private money, because you're competing, let's say, against a much wider scope in that, or?
Yeah, from our side, I mean, to your question, there is a lot of money chasing infrastructure, but it's only focusing on a certain part of the market that is really crowded. So large cap infrastructure businesses that are easy to manage, and you have a polished advisor deck that presents you the opportunity. There are hundreds of asset managers who would love to have that opportunity. Obviously, that makes it very crowded and then drives the price up. What we want to do different is to focus on opportunities that others are not. And for example, where a lot of work is required to either get the deal done or get your return afterwards. So we've bought a utilities business in the UK, Leap Utilities, which basically has networks and connections to end customers for water utilities, essentially. So you'll pay your water bill to our business. And we started with 2,000 customers, and we grew that to 160,000 over 5 years. Now that requires a lot of work, effort, active management from obviously the management team, but also from the board and the shareholders. And that is where you see opportunities where there's much less capital trying to get into those opportunities, because they're much more hard to manage and a bit more difficult to get those deals done. So yes, a lot of capital trying to get into the large cap, easy to manage opportunities, but then our task is to find those that are otherwise overlooked.
So in the mid-market or small cap area, or where the deals are more complex. We touched on, well, the opportunity set expanding, but of course there is always the question, can the investors access that? And for pension funds, or maybe also an insurance or a family office, might be easy enough to buy a private equity fund or an infrastructure fund if they like to. But what about the wealth management channel? And maybe here, Daniel, you can elaborate a bit on how can you gain access, because, for example, for an LP investment in private equity, you would maybe need 1 million or 5 million to be able to participate.
Yeah, so obviously the access into a certain investment, that's what's most interesting for the asset manager who wants to find some money, how he can attract certain pots of money for his strategy. And obviously what you're mentioning, I believe that private market investments are underrepresented in private wealth management. I think on the institutional side, the allocations are done, especially on private equity side. That's why you have a lot of dry powder. But the private market and the private banking always struggled how they can invest into it due to the restrictions like you mentioned. So it's always one thing how you can slice it down to make it easier to access, to not onboard every investor with a fund. And that's obviously one of the use cases where you can plug in a securitization of putting the investment into the structured product, basically, to make it bankable, to make it investable. But it's not restricted only to private banking. Also on, and I'll give you an example, on the insurance side. They also have the restrictions in regard of capital adequacy, of certain investment guidelines which they must obey to. So one transaction we have been also setting up is equity finance transaction for an insurance company where they're financing a lot of so-called Teilkäufe, where parts of a house are sold and they need to be financed through an ongoing flow of money into the propco.
Yep.
And for an insurer to do that via private equity or via an equity investment, it's very capital intense. So they had the need to find an instrument which is not requiring them to put too much equity behind it. So what we built in the end is like a mortgage bond, which was secured with the mortgages of the houses to make it more efficient for the insurance company to invest into this strategy.
Yeah.
There are different strategies which have different pitfalls, and you need to find the right choice to make it investable for this pot of money. So we have the private banking pot of money, we have the institutional pot of money, and one new thing is we have this crypto universe pot of money where many people are also hot to get it into their funds or into their strategies to invest onwards. And you need to play the different parts of the piano to make it fit.
Yeah. So basically the use case is not only to make the access easier for small investors, but also can be regulatory reasons why you can help them to structure a solution.
Yeah, for big investors, they're also having a need. Every investor has a need how you can access a certain investment, and then you need to understand the investment, how you can improve it.
Yeah.
Otherwise, you're just putting an additional investment vehicle on top of it, but there are means also how you can improve the underlying investment with collateral schemes, which you can bring up to the next level, which then again can result into a better capital ratio for the investment.
Good. Maybe then let's move on and go to the investment process and the securitization process. Could you maybe describe that a bit and bring it a bit closer to the audience? Maybe Tasso, you start what you're doing on your side and how does it work? So how do I end up from a universe of opportunities, as we heard, and then with an actual asset that is in your portfolio?
Before that, may I address one question to Tasso, to my understanding, to enlighten me a bit. What kind of interest or rate of return are you targeting for your investor?
That's a good point. So we're probably on the lower double-digit point that we want to deliver to our investors. So that matches then to your point around private debt is probably a little bit lower. And then investors want that higher return when they invest in equity. Now, to your point, how do we invest? So it starts very early. So at Ancala, as I said, our edge is we go to opportunities that maybe others overlook. And how do we find those? It starts very early, where we have what we call idea sessions in the team. So we're 50 people in London, and every couple of weeks we meet all together and people present ideas on where should we invest, what are areas people have come across in their daily lives of there's an infrastructure opportunity that is maybe not on the front news of every other investor. And there are good examples of where we found them. So one of them is, for example, we invested in an aerial emergency services business. So it's those guys that if you are on the skiing slopes and you have an accident, then a helicopter is coming to rescue you. So we have a business that was previously owned by Babcock, which we now own. And that is an area where no other infrastructure fund has previously invested in. And we found this because our team came up with this idea. So it starts very early to really make sure that we find those opportunities. And then obviously it's a very thorough due diligence process, where also what helps is that we work with our operating partners, so a network of people who have had their careers as CEOs and board members, and they can, much more than an outside advisor, they can really diligence a business and make sure we focus on the right areas that are critical. And then once we decide to make the deal, then it's really about the active management. So being on the board, making sure management develops the company in the way they should and our investors want us, rather than leaving them on their own.
Do you have a specific example of this, running the company and doing some development, or maybe taking a company into a different direction?
Yeah, sure. So Leap Utilities, again, which is our UK utilities business, was very much focused on water and electricity connections to end customers. And over time, through our board active involvement, we then transformed it also into providing heat. So as many of you will know, currently a lot of residential heat is delivered from gas, and especially in the UK, that is currently being phased out, obviously due to sustainability reasons. And then our business can play a very, very good role in providing electrified heat. So heat pumps, for example, ground source, water source. So we then developed a service offering with the business to provide that to the market, and that has been very, very successful. It's one of the good stories.
Thank you. Maybe Daniel?
Maybe I would give another real-time example, real life, not real-time, different words. So real-life example, how we have been cooperating with a fund manager in translating a certain investment idea into an investable solution. Yeah. Unfortunately, it was not Tasso yet, but I'm sure we will find something for the future. And it was around, I think, meanwhile, 8 years ago. 8 years ago, we have been approached by a big fund manager who said, I have this company there somewhere in Germany called Deutsche Palettenlogistik, which is doing outsourcing services for Europallets. So Europallets are this thingy where you deliver one good from each the producer to the sales point. And it's a huge, tremendous amount of logistics involved into that. So in the Europallet market, I think there are daily movements of tens of millions of getting all this logistics in place. And German Deutsche Palettenlogistik, what they are doing is they provide outsourcing services to the distributors and to the producers by bringing some the pallets and organizing all the logistics around it and making like a pooling concept, so that you don't need to bring back your own pallets, but you're getting like a voucher, you can take the other ones. They are very successful in the German grocery stores and this environment, and they're having a market share back then of around 10%. They struggled to get bank financing because their balance sheet was very long. They had to buy those pallets to then rent onwards to the producer and to the market environment. And this fund wanted to invest into them in a debt structure, not equity, but in a debt structure. And he was like, how can I make this investment more secure? I don't want to give unsecure financing because the balance sheet is very long, so I want to use the Europallets as security. So what we have arranged for them is like a credit-linked note. The loan was granted to Deutsche Palettenlogistik, and this loan was secured on the one hand side by the Europallets, on the other hand side with the receivables they had against their clients. And their clients have been the Oetker, the Aldi of Germany, so very interesting receivables in the end, which form a very stable collateral. So over this 8 years, together with this fund from Germany, from Frankfurt, this company grew very successfully, and we have been able to see it in the balance sheets. They have been able to rise the revenues from 50 to 150 million, and obviously the company value as well by giving a new way of financing into this possibility of investing into infrastructure, into logistics. And that's where kind of the advantage can come together between the fund investor who has an idea, but in order to support his investment into the opportunity, there might be a different tweaks and twinkles also coming from that direction. So it's not only about making it accessible to the investor or a certain group of investors, but the cooperation and the thinking process between the investment team at an asset manager and us as a securitization company bring additional benefits for the structure and for the return of the end investor.
Yeah, maybe this was probably one good example of what you can do with securitization. Can you run us through the general process, how that works? The investor comes to you with an idea, there is an asset.
The process itself, it's like all the things you've done too often, it sounds so simple to you and you forget that it sounds eventually a bit more complex to people who have not done it, let's say, thousands of times. So in the end, you need first a vehicle where you can ring fence an asset. That's a starting point in securitization, because you don't want to commingle that risk of the investment with other risks. So you don't want to have it issued by a bank or somebody like that, because then you combine it with the traditional issuer risk. That's why you have infrastructure funds or other funds which are using the same concept. So we have this vehicle which can acquire the asset, like fund shares, and you issue against that a certain instrument. Usually it's a debt instrument, it's clearable, it can be booked into a custody account, it can be secured, it can be unsecured, so you can have a security agent on top of that. So you enhance it with certain features, this debt instrument, which is clearable. And obviously the beauty for the asset manager is he can buy it into his investor accounts through the trading desk of his custodian bank, or if it's an institutional large investor, he just enter into a subscription document, and then the paper is delivered to him against the flow of money. Then you acquire the underlying asset, and basically your job is done. But the challenge is the additional features you put on top of that. As an easy pass-through vehicle is easily created, but you're not fulfilling the end of the story, because it's a bit more. It's what feature you can use, what legal documentation you can use, what is good for the investor, how can you enhance his capital efficiency.
Can you maybe mention one or two more of these features? You mentioned the example with the insurance company, the CLO example. Can you maybe give another example, what you would want or what might be useful for some end client?
Let's take a look on a venture investment. Venture investment has a completely different need than an infrastructure investment. On a venture investment, you have somebody who is setting up a company who wants to have a limited number of investors in his league table. So you usually don't want to have a company in your early days where you have 100 different investors, because it's very difficult to find a common way of steering the company. So what we do if we securitize venture, we introduce something what we call the share strategy agent, who's conducting all those ideas together of the investors and who has one single vote. So in effect, the cap table of the company is reduced to just one investor. The securitization company, you have somebody professional who's managing this investment, a bit like on the infrastructure side, on behalf of a certain pooled amount of investors, and one decision is made together with the company. And you can also add certain features that you reserve some dry money within the vehicle in order not to get diluted over time. That's also something which you want to watch out if you do venture investments. And so you can enhance this venture investment through the securitization to make it more easy to invest in, to give additional due diligence documentation to the investor to round up his journey.
So the field of features you can add is quite wide, if I listen to you.
Yes, you can also look into different structural features, like on the infrastructure side, where you have stable cash flows. The investor wants to receive stable cash flows, so you can turn dividend income into interest rate or coupon income, which is interesting for certain investor categories. But you can also accumulate profits over time if you choose an intransparent structure for the securitization. You could also set up a transparent structure if it again offers certain tax benefits to the end investors. So there are certain considerations to be made.
Good. Maybe next question for both of you again, but maybe Tasso can start. What's the question you and your team get asked from investors the most? Where are the questions when it's about the infrastructure?
They're always interested in, firstly, what can go wrong with your businesses? And then we need to have made our homework on why are our businesses downside protected and why will they not develop maybe in the same way as more, say, retail businesses, which can be a little bit more volatile in a downturn of the economy. So we need to have made sure we're hedged against interest rates, we're hedged against commodity risks, and we just have a good business strategy in place that allows us to prepare for those downturns. And then secondly, a big question we ask is, well, your returns tend to be a little bit higher compared to some of your peers. So where do you take the additional risk? And then the answer there is usually, well, we don't like to take additional kind of company risk. We don't like to invest in more risky businesses. We like to invest in areas where we generate the return because others simply don't find those opportunities. So again, having invested, for example, in companies like Cyprus, where we bought the largest wind farm, that's not a market where traditional investors would really focus on. If you try to get a wind farm in Germany or anywhere in Central Europe, you will likely get a much lower return. If you buy the same business in Cyprus, do a little bit more work, probably need to engage with the stakeholders, the government, the politicians, a bit more than you would otherwise have to do. Then you can, with the same business risk, deliver a higher return there. So these are some of the questions we typically get asked.
Good. Daniel, what are the questions that clients have towards you?
Oh.
Maybe just one example.
Well, clients is first the question, is the investor or is it the initiator of the product? The initiator often has questions like you. How does the process work? How much does it cost? What is the size and what does it make sense? And then the journey starts, because then we need to ask, where do you want to distribute? Do you want to distribute? Is it set up for one investor? What are the specific of the investor to get it in place in the right format for a certain audience? If the questions are coming from the audience, then we usually make it very simple to us. We say, we as an infrastructure provider for the performance, for the alpha, ask the manager. Our job is a different one than generating the market performance within the vehicle. But obviously for other questions, we are very happy to support. How can I buy it? How can I sell it? If I can sell it, is there liquidity? And so on.
Yeah, okay. So the questions are more from the asset manager side and less from the end client side.
Yes.
Okay, good. Maybe another question with regards to innovation on an industry level. How does innovation in your respective fields look like? And maybe Tasso, you can give us an example. Maybe, well, some innovative subsector or the way you work, how that's changing over time.
Yeah, so we're quite careful to not follow always the latest innovation when it comes to where do we invest in. So let's take an example, hydrogen investments. There's a lot of money flowing into it, but a lot of that is quite speculative. So we wouldn't probably count it in the same way as, well, this delivers the stability our investors want, then maybe some others would do. So we're a little bit more careful of investing directly in the latest innovative trends, not knowing how those really are going to develop over the next decades, because that's our investment horizon. Instead, what we then often do, we try to benefit through our existing portfolio companies on those innovations without exposing them to the risk. So again, to give an example on hydrogen, we have a port in Norway that largely focuses on servicing oil and gas companies. So they have their vessels to the offshore platforms, which docks then on our port. And then we are now working with another partner to provide ammonia and hydrogen as a renewable fuel on our port. So that means we get lease income, we get service income for those hydrogen and ammonia producers on site, but we're not taking the actual risk on, are the vessels actually going to use it over the next 15 years? So that's kind of, we try to take part on the development of the innovations, but we don't want to put our capital necessarily into it, knowing that there's quite a bit of risk over the next couple of years.
Good. Daniel?
I think the question on innovation also shows a bit the challenge we are working through the panel. It's like a specific investment and asset manager question, whereby as a securitization company or an infrastructure provider to the market, we tend to see things a bit more holistic. So if Tasso speaks about innovation, he sees certain innovation risk in the underlying companies and to avoid it in order to protect the downside protection on that. If we talk about innovation, we have more in mind what is changing is the industry in the financial sector. What changes are we observing? And private markets, I think, is a sector which is in the heart of innovation, of change, how certain asset management and how strategies are run. Why is this the case? Again, initially, there's a need from the public sector to attract money from the private sector into that to allow for change. Infrastructure is a perfect example for that. And this innovation was supported by different parts of legislation. So in Germany, you have the Zukunftsfinanzierungsgesetz. On the EU level, there are different parts how you can allow this change to happen. And then you're suddenly in the full tokenization world. Because tokenization is something where many people believe it can support this attraction of money into a sector. So we also decided tokenization of a financial instrument fits to us somehow because we want to support not only our issuances, but other issuers, how to bring tokenized instruments to the market. So I'm not talking about crypto assets, but I'm talking about tokenized financial instruments, can be fund shares, can be equity, can be debt, under a certain regulatory framework. In Switzerland, this would be the DLT framework. In Singapore, you also have certain sandboxes how this is enabled. But tokenization, there is one part on the wish list of many jurisdictions for private market investments to allow the flow of money from the private sector into those kind of asset classes.
So the digitalization itself is more of the innovation in your work, so to say.
So I think the new form of a financial instrument in tokenized ways utilizing the blockchain is one part of innovation. It allows to continue a digital process into a technical digital security. And I think that's the exciting part. You can certainly have a smart contract where you have a certain set of monitoring and other things programmed into it to make it more secure, to make it better for the investor.
Yeah.
Other believes that this brings certain liquidity to the market, where I have certain question mark, because liquidity comes with transparency, but there we have another new thingy, new baby in the town on innovation. This is AI.
Yeah.
What is the combination between AI and blockchain? Is this the solution to bring liquidity to the market and then to attract new money? So that's eventually one answer to your question.
Okay. Maybe one last question, and then we would open it for questions from the audience. So risk was mentioned. You mentioned that you were able to buy an asset in COVID. In general, I would be interested, how have your solutions performed during 2022 maybe and COVID, and what were the learnings from that? So maybe you.
Yeah, so I think it was interesting because from roughly 2010, when maybe especially mid-market infrastructure became more prominent as an asset class, until 2020, literally you couldn't lose any money. Like, it was a great time. And then COVID was kind of the first time where it really made a difference whether you had a good portfolio or not so good portfolio of infrastructure business, and it kind of split the group of asset managers a little bit in different segments of who's performing well and who doesn't. I would say we were more on the performing well side. Our portfolio was quite balanced. We did buy an airport 6 months before COVID, which obviously was a difference to what we had hoped how it's going to develop. But then it's about having a balanced portfolio, and a lot of our businesses did perform then very well, and on a balanced perspective then, especially now looking backwards, had a very good development. On your question about learnings, I think two. The one is having a low leverage, so not too much debt in the businesses, really helps in downturns, because you can remain flexible, you can take decisions that businesses that have very high debt aren't able to do, because basically all they need to work towards is to make sure they can pay back their debt in times when it's a little bit tougher. And the second point is it really helps to have these operating partners in your fund who have been through all of this many times before, and at least can draw certain parallels to previous situations, and how do you get out of those situations, rather than just financial people who don't really know how to operate a business. So it really helps there to have this more practical operating perspective.
Okay, thank you. Maybe.
Yeah, again, a
You share
bit
some learnings.
different answer than from the investment side.
Yeah.
So we are more, I would say, also on the investor side. And private market investments have completely different risk profiles than listed equity investments. The market risk is one component which Tasso was describing, but there's an additional huge risk component, which is the transformation risk from the public sector, like you mentioned, wind park, solar. So there's a risk that the legislation is changing. We saw changing subvention in Germany. Also in the US, we see suddenly political risk affecting an investment through a different legislation. So that's one big risk. The other big risk is fraud, obviously, in the private market. It's less observable. There are different mechanics working. So the fraud risk is also another big risk. And the lesson learned is watch out who pays whom. Watch the flow of money and see that everybody is aligned correctly, that you don't end up in an originate to distribute model. And in the end, only the investor, the end investor, is taking all the risk and everybody is paid up front.
Okay. Good, thank you. Now we would like to open the panel for questions. Yes?
Question for Tasso. 2020 was a dislocation year during COVID. Where do you see dislocation now in infrastructure as an asset class?
Sorry, how do you mean? Where do we see the
Dislocation. You mentioned 2020 as a case where you were able to buy a railway company at a good price. Now in this environment, where do you see dislocation in the infrastructure as a strategy?
Yes, obviously COVID was a very special case,
Yes,
and it was.
I'm asking.
Yeah, you're right. I'd say a lot of family-owned businesses had a really tough time because of rising interest rates, because they weren't really able to protect themselves in the same way as maybe larger companies with big treasury teams were able to protect themselves. And that really didn't work in their favor. And what that means is they're, in many cases, running out of capital, need a strong investor on their side. And that is where we can then step in. So this is where you find opportunities that are still very, very good, even though they might not be that kind of prominent, essentially. So that could be one comparable to the situation in COVID, where it was a little bit unknown how many businesses will develop over time. But yeah, if you did your diligence right, you could find really good businesses to invest in.
How do you choose a new person to manage a company where you assess it like it was a need to change the management?
Yeah, it's a very, very good question. We probably have to do this. I sit on the board of 4 of our companies, and kind of once or twice a year, you have to appoint, not CEO necessarily, but one out of the 5, 6 management members. How do you select them? I think we kind of got away a little bit from trying to search for someone who has seen the industry for the last 20 years. That is not necessarily the most important thing for us anymore. The most important is it someone who is really, especially for CEO, who is has a rounded capability to not only be, I'm a salesperson, I've kind of learned the other things a little bit on the side, or I'm just a finance person. You need someone who can really challenge and stretch their direct reports very well, which you need a really good understanding of all the functions in your business. And it's someone who is, quite frankly, able to build a good strategy and convince us that if they would join, they would make a great business out of it. What we don't want to do is tell the management, this is what you need to do. What we want is the management to tell us, this is where I see the business, investor, or do you sign off on this, yes or no? So maybe that's to your question around who do we want to select.
Temporary thing.
How do you mean temporary?
Like when you say that you need a generalist who understands all concepts.
Correct, yeah.
So it is to kind of give that change that you already expected as the strategy you already have, not to implement it.
Yeah, correct, yeah.
Thank you for that.
Good. Maybe one last question there in the back.
A question regarding the infrastructure sectors. Given the expectations of institutional investors on risk reward and yields, are there any sectors which you would not invest in or at this time prefer not to?
Yeah, it's the ones that are just very, very crowded and everyone trying to pour money in. So data centers is one area where you need to be really, really careful where you invest in. Not because all of them are bad, I'm sure there are good ones, but given there's so much focus on this sector right now, there are a lot of businesses that just go very early into the market and present themselves as more than what they maybe really have. And we need to be very careful there. So we try to go a little bit against the trend in some of those cases. So in COVID, where everyone was about investing in fiber businesses, because from now on, everyone will only ever work from home, we sold our fiber business because we saw basically people are paying crazy prices for those businesses. So yeah, there are some sectors you want to maybe have a very close look before you invest because they're very crowded right now and a lot of hype around them.
Good. Maybe we can do that after the entire round. Or you have a question for Daniel?
For Daniel.
Okay, go ahead.
So you are, I just checked, the company's from Germany, so you're based in Germany, Switzerland, Singapore. Is it the same, like Spain is a market for you, or does change much between European countries?
Spain is also a market where we are active in. So, and the change between the markets is always understanding the underlying asset, the jurisdiction of the underlying asset, tax and other implications from that country. And then on the distribution side where you can sell to, but Spain is also one market and also an interesting market. And speaking about Spain, it's summer, it's getting warmer. We decided to bring ice cream. I need to make a bit of advertisement for our ice cream. So we are down here, pick up your free ice cream and enjoy the summer.
Good. I think that's a good concluding remark. Thanks everyone for your interest in this panel, and hope to see you next year.